So I'm curious, Arn, you spend a lot of time, I'm sure, digging into different markets, and you've relocated, in the last decade to Greenville, the South Carolina area. So you're familiar with the Southeast. That was very intentional on your part. What's an underrated market or two that you are keeping an eye on as things are shifting?
I actually kind of think there's markets in the Midwest that may offer some opportunity that will give you both cash flow and some appreciation. Could be Oklahoma City, could be Tulsa, could be some markets in Tennessee or Kentucky. So I'm very much focused in the Carolinas. So I don't know that I'll personally do anything outside the Carolinas, but I do see some opportunity there. Specifically in the Carolinas, I would point to the Greensboro, Winston-Salem area, known as the Triad. People are more familiar with the Triangle, which is Raleigh-Durham. And of course, Charlotte's on everybody's list. So there's three big metros in North Carolina: Charlotte, Raleigh-Durham, and Greensboro, Winston-Salem. And by far, Winston-Salem and Greensboro have had the least heat to them. And so they're not quite as pricey. The returns are a little better, but the factors that drive the Charlotte and the Raleigh-Durham markets are also in play in Greensboro, Winston-Salem. So I like that as a market, and I've been spending some time there. In South Carolina, I really kind of like outside Charleston in Somerville, which is a little bit inland, and there's Boeing and Volvo and Mercedes-Benz. We're up here in the upstate of South Carolina. We have Michelin and BMW. So those are a couple markets that I hope to get more active in.
I think, and the common denominator across really all the markets you mentioned is strong demographics, good employers, and a diverse set of employers, right, that are going to likely weather the coming recession and provide kind of that floor for the local economy, which translates into real estate. I mean, I think commercial real estate in many ways is a bet on that local economy. And so if you have that mindset going in, you can avoid a lot of pitfalls.
Yeah. And I know this is going to be crazy, but I started investing in real estate before there was Microsoft Excel. Okay. Now, some people may think that's crazy, but I promise I did it. I got a little HP 12C calculator that some of you folks may know. And what I talk about investing is, one, I'm kind of a qualitative investor, and I rely on my instinct and my gut developed over many decades. Certainly you look at the data, but for me, it's kind of, does the deal make sense today? And do you have logical and rational reasons to have optimism about the future of that market? Which kind of circles back to what you said of finding these industries and diverse economies that will kind of set a floor that will provide the economic juice to improve that region and make that region a good place to invest. So I think that's exactly right. Figure out what areas you feel optimistic about the future of that area, and invest your money there. And I think you used the word bet. One of the great things about being an investor is you actually have to put your money where your mouth is, right? And it's not some theoretical discussion, right? It's you do your research, you do your investigation, you talk to 1 million people, you get a sense, you run the numbers, you crunch the numbers, and then ultimately you make a decision and you invest your own capital there. So it's a fun process, and you have to believe in what you're doing.
And I think sometimes thinking about it in that lens is helpful. Sometimes, unfortunately, in all investments, not just syndication, it's just the niche that we're in, but they can get pitched as sure things, right? Or the way that people will talk about them, there's this preferred return and it guarantees this. And well, when you dig in, it doesn't guarantee you anything. It just says if there is growth, this is the first slice that goes to investors, right? And so introducing even into our language some of those types of idioms, like you're making a bet on the local economy, I think it's a more realistic picture of what's taking place. But Like you said, Arn, with your 45 years of experience and incorporating the data that we now have, it allows you to really get in front of a lot of the issues that can pop up. Now, there's other issues unrelated to demographics that can still come and bite you. You have to be a good operator. You have to buy the right property in those markets. But man, every hurdle you can avoid at the outset is one less that can come nip at your heels. And that's really what this game is how can we minimize our downward exposure and how can we maximize our upward momentum?
Correct. And the thing I often say to LP investors is, if you were to pick 10 stocks to buy, would all 10 be great deals? Would all 10 be very profitable? No, probably 2 or 3 would do well. 3 or 4 might do very poorly, and the rest might do kind of middle to nothing. And so I think it's a lot easier in real estate to have a little higher batting average in picking those 10. You're probably going to win 8 out of 10. And your 1 or 2, let's call them duds, are going to be minimal to no loss, right? Like in my experience, a poor real estate deal, most times at worst, it's a break-even proposition, and we're disappointed. It's not you lose 50% of your equity. It just doesn't happen in real estate, especially if you're in the right markets. I remember in the Bay Area, 2007, 2008, home values on the peninsula maybe dropped 5%. And this was after, 8 years of going up 15% a year. So good markets, they're going to stand up to the time. And it just, the real estate's more secure. It's real. You can see it. People have to rent. And so there's a lot of things to like about it.
Yeah. I'm curious, Arn, shifting gears on you a little bit.